UBS just paid $3.2 billion to acquire Credit Suisse, a bank that in 2018 had a market cap of $49 billion.
We do have a deal, and there are a couple of critically important things to take away in the first take. One, we have a bail-in of bondholders. This is what the market will focus on tomorrow morning. When I got on the plane in Dubai this morning, this was a $1 billion deal. This afternoon in Prada Platz, it was a $2 billion deal. It's now a $3 billion deal, and it has a lifeline, $100 billion from the regulators, the SNB. They're standing behind this. And Colin Kelleher made it very, very clear. This is the man who steered Morgan Stanley through a bailout in the GFC. He made it very clear. We're not in the risk business. We're a capital-light model. And the investment bank at Credit Suisse will be reduced to 25%, approximately. That is the size. The backstop is in. The liquidity is there. Systemic risk for now. We'll see how we go over the next 12 hours. For now, this is a salvo at saving systemic risk. It's critically important that we understand what AT1s are, which are the additional Tier 1 capital. They were put in place as the fundamental backstop to another situation like this. My first take on this is that the bail-in is a message from the Swiss to say, look, somebody's got to take pain here. The equity holders will get a little bit of something, in other words, 0.76 Swiss francs. But the bondholders who get handsome yield for AT1, those days are gone. My question will be how the credit markets react tomorrow morning across Europe, and most especially within the banking sector. The other dynamics that you've got to keep in mind is this. There is also a backstop if things go wrong, and Kelleher made it very, very clear that they're not in the business of trying to make losses. They're going to look at the whole book, the whole credit book, the whole derivatives book. They're on the hook for $5 billion, and then the SNB comes back in, and they're on the hook for 9 after UBS. So there are a myriad of things to keep in mind here. I just want to put one other thing to the two of you, which is this. At the moment, it looks as if no dividends are to come from Credit Suisse. I've got somebody screaming blah, blah, blah. He'll get a lot more blah, blah, blah before I'm finished. The bottom line is UBS is a dividend bank of choice, but what I didn't hear in that news conference was that there's any pause, cessation, or temporary pause on the dividend from UBS. Kelleher is chairman. Ralph Hammers is the CEO. The king is dead. Long live the king, and that king is UBS.
Welcome to Financial Fortune, where we bring you the latest news and insights on the world of finance. In today's video, opinions of two prominent investors who were involved in the Big Short during the 2008 financial crisis. Michael Burry and Steve Eisman have recently shared their thoughts on the current banking crisis, particularly the situation with Credit Suisse. Investors like Michael Burry, recently he made the following statement on Twitter, quote, "The crisis could so very quickly. There doesn't seem to be any real threat here." Another man featured in The Big Short, Steve Eisman, was recently heard on CNBC predicting that we will never see another 2008 again.
Do you see any sort of a banking crisis unfolding here in the United States and or in Europe?
My partners and I looked at this really carefully. I would say, number one, the large U.S. banks are better capitalized and have less risk than they ever had in anyone's lifetime. The European banks, while they're not as well capitalized, are certainly better capitalized than they are. That isn't to say there won't be pain if Credit Suisse goes down, but it's not an 08, thankfully.
So the counterparty risk in terms of transmission mechanism, that doesn't exist to the extent.
No, it does exist.
It does exist.
It's just, people have been pulling back from Credit Suisse from a long time. If you hear that the company goes bankrupt, there will be losses. It's not death-defying losses, but it'll be a problem. It's not going to take down the system. I remember in 2008 when everybody was trying to get bailed out, if you looked at the U.S., the size of U.S. GDP was many multiples bigger than all the bank balance sheets combined. We looked at Credit Suisse today. Credit Suisse balance sheet is $500 billion. The GDP of Switzerland is $800 billion. So could Switzerland do something? Yeah, they could do something. It's not going to be easy. Not easy at all. The other thing I would say about Switzerland, unfortunately, is they really don't have a lot of regulators. So what they actually know is not, I don't think they know a lot. If you look at Germany, What I've heard is like 500 regulators in Deutsche Bank every day.
Right.
I think the number of regulators of the Swiss bank, I could be wrong, is like 250 for the whole sector.
But that statement paired with the notion that Credit Suisse might be too big to save is sort of a frightening.
Well, it's frightening and it's not franking. It's going to be ugly.
Right.
You know, Credit Suisse, I'll say euphemistically, has been a problem child in the investment banking industry for as long as I can remember. And it's always had cultural issues. But, you know, it'll get unwound. It'll be painful. It's only going to be painful for Switzerland. You know, we heard today that they maybe want UBS to take it over. Believe me, UBS does not want to take it over. That's for sure. So I don't know how they're going to unwind it. They probably will have to. I mean, is it possible that they could save them? Maybe. But, you know, the credit default swaps blew out to like 800 basis points. That means you really can't fund yourselves. I heard that they were offering 6 to 7% deposit rates in Asia, and people were still pulling their money. And nobody will be a counterparty anymore. That's more than bad.
Yeah.
That's really bad. So how Switzerland will deal this, it's anybody's guess. I'm not in the room.
Do you see that we're in a new era now for regional banks, for what the model will be and how to think about the whole banking structure, the whole sort of business of banking?
When President Trump passed that bill and raised the threshold from, I think it was 50 to 250, now I think that was bad. I think Elizabeth Warren has a real valid point about it. But we looked at the stress test for last year. And the stress test for last year had about a line in it about rising rates. And the rest of the entire stress test was about credit. So even if Silicon Valley had been in the stress test, given what the stress test says, I don't think the regulators would have caught it.
They would have passed it.
And, you know, the stress test is basically fighting the last battle. That battle has been won in the large banks. They're better capitalized. Their risk, even with that capital, is much narrower. You know, as Warren Buffett says, when the tide goes out, you see who's naked. This is a different tide. This is not a credit tide. Credit quality in the United States is really good. This is a tide of a mistake, which is some of the regional banks, especially those that have a lot of deposits above 250, bought long-term bonds at very, very low levels and have massive mark-to-market losses. That's why Silicon Valley failed. Also, they failed because they had a very, very concentrated type of deposit base, which has a very big herd mentality. All the regulations are probably going to get much more stringent, making the banks much less profitable. And that's not going to be clear for many, many months. So why be a hero? Because you have absolutely no idea what's going to happen.
Would you say that the banking sector right now, with the uncertainty given what will happen on a regulation front, that financials are uninvestable right now?
I would say, you know, we were looking as a team at every single bank. And I would say, given the change in the regulations, the best you can say is you don't know. And if you don't know, you shouldn't play. I think what's happening is we're moving from one paradigm to another paradigm. So the paradigm of the last several years has been rates are very low, you're paid to take risk, and you're actually paid to take a lot of risk. So, you know, what did the best over the last 10 years? High growth tech stocks. And what did the best within high growth tech stocks? Super high growth revenue stocks with negative earnings. Okay, so what did the worst last year? Super high growth stocks with negative earnings. Now, are people going to go back to that? I don't think so, especially if rates stay up. So what I think is coming is Tina is dead. Number one, I think you're going to have a much more diversified portfolio. You certainly can leave money in your money market fund because it's over 4%. I'm not sure if it's over 4% tomorrow.
Maybe not
but
anymore.
It's still around 4, which is fine. I think over time, you'll be able to buy some treasuries and buy some bonds. And there are going to be a lot more themes than just tech, infrastructure, bringing the supply chain back to the United States. And you're going to need to manage risk a lot more than people have. So, you know, people who's outperformed over the last 10 years? Tech investors. You know, the group is now so volatile, I think everybody should take their exposures down. Not that you should invest in tech at all, but you really should diversify more of your portfolio, take down your risk, manage your risk, tailor your portfolios to your clients. One size does not fit all. And given the fact that, my team and my partners and I, we go back every single day. Is there a recession? Is there not a recession? I watch your show. You've had people come on and say there is a recession, and a month later they say it's not a recession. It's a very uncertain time because we've never had the confluence of stuff that we have today. And I think that argues for taking less risk.
And that concludes our video about the opinions of Michael Burry and Steve Eisman on the current banking crisis, particularly Credit Suisse. It's always interesting to hear from investors who have a proven track record of identifying risks and opportunities in the market. If you found this video informative, please give it a thumbs up and consider subscribing to our channel for more updates and analysis. Thanks for watching.